The cotton market was unforgiving that October morning in 1979. A young trader watched his screen in disbelief as months of careful savings evaporated in a single devastating move. 60% of his account gone. Most would have walked away, defeated and broken, but Paul Tudor Jones did something different. He asked himself a question that would transform him from a failed trader into a billionaire legend. Like this video and subscribe to the channel. Your engagement is crucial for the future of our channel. What Jones discovered in that moment of crushing defeat wasn't just a trading lesson. It was a complete rewiring of how successful people think about uncertainty. He realized that the market wasn't punishing him for being wrong about cotton prices. It was teaching him that prediction itself was the enemy. This revelation didn't just save his career. It became the foundation of one of the most successful trading philosophies ever developed. The question that changed everything was simple yet profound. What if success in trading has nothing to do with being right and everything to do with thinking in probabilities? Let's explore how this shift in thinking can transform your approach to the markets. Executing your edge repeatedly requires detachment and clarity. This edge might only succeed 40% of the time, but if it generates more profit when winning than losses when failing, the strategy works. The mathematical logic is straightforward. Everything else is just background noise. The critical distinction lies in perspective. Most traders are trapped in ego-driven thinking. They obsess over whether a specific trade will work instead of evaluating the setup's historical probability. This mental shift from outcome-focused to process-oriented thinking separates amateurs from professionals. Your trading challenges stem from biological programming, not personal weakness. Humans evolved to survive through simple cause and effect patterns. You see lightning, you anticipate thunder, you eat a poisonous berry, you learn to avoid it. These survival mechanisms served our ancestors well, but in financial markets, this same neurological wiring becomes a liability. Trading defies linear logic. It operates on probabilities. A strategically sound trade can lose. A seemingly poor trade can win. Short-term randomness obscures long-term clarity. Your brain instinctively resists uncertainty and craves control. When that control eludes you, emotional responses emerge. Fear, greed, frustration, all destructive to trading performance. Most traders aren't truly interested in trading. They want validation. They chase the dopamine rush of perfect entries, precise market calls, and successful reversals. They desire the win, not the disciplined work. This emotional addiction to being right prevents genuine financial success. When a trade fails, their entire self-image collapses. They question their system, their setup, themselves. In contrast, probability-focused traders anticipate losses. They design systems that accommodate randomness. They understand that even the most robust setups can fail 30%, 40%, or more of the time. This acceptance doesn't indicate failure. It demonstrates professionalism. The transformative question becomes, do I genuinely believe this trade will work? When you're trading, the critical question is whether you truly know that your setup has a positive expectation over 100 trades. If you're still seeking certainty and wanting every trade to work, you're trapped in prediction and essentially gambling. But if you've started to understand probability, you've taken your first real step toward genuine trading. The moment you stop needing every single trade to succeed, you unlock a profound freedom. This freedom allows you to trade with discipline, emotional detachment, and durability. This isn't about intelligence, it's about identity. Intelligent people frequently fail at trading because they approach the market like a solvable mathematical problem, believing more analysis creates more certainty. They desperately chase non-existent answers. Trading isn't a puzzle to solve, it's a process to navigate. The goal isn't outsmarting the market, but outlasting your own emotional responses. To achieve this, you must stop identifying as someone who predicts market movements and start seeing yourself as someone who consistently executes a proven strategy. Your first critical task is to release the need to be right. Stop asking whether a specific trade will win. Instead, ask whether the trade offers a positive expected value. Consistency isn't built on conviction, it's constructed through understanding probabilities. Your ability to accept, internalize, and live this principle will determine whether you join the 10% of traders who survive or remain among the 90% perpetually searching for a magical strategy. Let me challenge a massive misconception about trading. Win rate doesn't matter. This seductive number strokes your ego, offers hope, and creates an illusion of improvement. But basing trading success on win rate alone means you're playing the wrong game. Professional traders don't chase high win rates. They pursue something far more powerful, expected value. Expected value, or EV, is the true compass of probability-based trading. It's more than a number. It's a mathematical projection of your system's long-term profitability. The formula is straightforward. EV equals win rate multiplied by average win minus loss rate multiplied by average loss. This calculation reveals, on average, how much money you'll make or lose per trade over an extended period. Let me break down the trading systems mathematically. Trade A boasts an 80% win rate, with average wins of $100 and average losses of $400. Trade B has a 30% win rate, with average wins of $500 and average losses of $100. Most traders would instinctively choose trade A because of its high win percentage. However, the math tells a different story. Trade A's expected value calculation reveals a different picture. At 80% wins, you earn $100, but at 20% losses, you lose $400. This results in an expected value of negative $80 per trade. Trade B, despite its low 30% win rate, actually generates $80 in expected value. The trade that feels like a failure is actually the one building wealth. The psychological mechanism behind this is fascinating. Our brains are wired to crave being right. We love the emotional validation of green trades and the illusion of control. This drives traders toward high win rate strategies like scalping small moves or using tight stops. But they miss a critical insight. A high win rate with poor reward to risk ratio is worse than random chance. Even with an 80% win rate, risking $500 to make $100 means one or two losing trades can completely erase gains. This is the hidden problem in many seemingly successful strategies, winning small battles while losing the financial war. Professional traders focus differently. They're not obsessed with win frequency, but with maximizing gains when right and minimizing losses when wrong. This approach enables true compounding. A system with a 45% win rate, averaging $25 wins and $900 losses, can still generate $630 per trade. A scalable, fundable strategy. Many traders brag about high win percentages while barely breaking even or slowly depleting their capital. The real wealth building happens quietly through strategic risk management and understanding expected value. He explained the numbers. A $400 loss and $1,400 gain. We calculated the expected value. At 0.75, it's $400, and at 0.25, it's $1,400, which translates to $300 minus $350 minus $50 per trade. He was essentially losing money with every mouse click, despite feeling like a winner 3 out of 4 times. In contrast, consider an options trader I know. Their win rate is 28%, with an average win of $2,400 and an average loss of $300. The expected value comes to 0.28, 472, around $300. With a coefficient of 6 and 772 minus 260, plus approximately $456 per trade, she was accumulating wealth while being wrong 72% of the time. This illustrates the power of shifting focus from win rate to expected value. Why is this concept so difficult to accept? The human brain craves short-term validation. It wants to feel like a winner today, even if that means being broke tomorrow. Probability players think differently. They view trading in long-term sequences and detach from individual trade outcomes. They stop asking, was I right? And start asking, did I execute my edge? Over time, edge wins. Not accuracy, not intuition, not streaks, but raw, consistent mathematical advantage. To implement this approach, first define your system with crystal clear rules. If your guidelines are vague, like buy when momentum is strong, you can't measure expected value. The system should be so precise that a child could follow it. Next, track real data. You need at least 100 trades to calculate expected value confidently. 200 is better, and 500 is ideal. Track win rate, average win, average loss, reward to risk, and expected value. Make expected value your primary performance metric. Even a system with a modest 0.25 return can generate wealth. It's not glamorous or social media worthy, but it's how compounding works. The emotional breakthrough comes when you let go of the need to be right. Embracing expected value means stopping the chase for perfection. You stop needing to win every trade. You stop overreacting to losses. You trade like a casino or an insurance company. Professionals who understand that math works over time. The ultimate question is simple. Would you rather win 80% of the time and stay broke, or win 30% of the time and build lasting wealth? Trading isn't just about numbers. It's about understanding your true identity as a trader. When you move beyond obsessing over win rates, you enter the mindset of a genuine probability player, and that's when the real transformation happens. The most overlooked decision in trading isn't about what you trade, where you enter, or even when you exit. It's about how much you risk when your edge appears. You could have the most sophisticated system, a proven positive expected value, precise execution, and still go bankrupt if your position sizing is incorrect. Let me emphasize that risking the wrong amount can completely destroy an otherwise winning system. Professional traders don't just execute setups. They strategically size them with mathematical precision and intentionality. They leverage a powerful tool many have heard about but rarely understand, the Kelly criterion. This isn't just another financial formula. It's the foundational risk management approach used by casinos, elite traders, and even sophisticated hedge funds like Renaissance Technologies. The Kelly criterion emerged in 1956, created by John Kelly, a scientist at Bell Labs. Initially designed for optimizing long-distance signal transmissions, it was quickly adopted by professional gamblers and sophisticated traders. Its core question was revolutionary. How much should you bet when you have a genuine edge? This isn't about guessing. It's a precision instrument that, when applied correctly, helps maximize long-term growth while protecting your trading capital. The fundamental concept is straightforward. If you have an edge, bet more. If you don't, bet less. And critically, never bet everything when you're uncertain. The formula for traders is elegantly simple. Kelly percent equals expected value divided by the reward to risk ratio. For instance, if your win rate is 60% and your reward to risk ratio is 1.51, you'd calculate your expected value by multiplying win probability by reward and subtracting loss probability by risk. In this scenario, that would yield a Kelly percentage of 33%, providing a mathematically derived position sizing strategy. Mathematically, you could theoretically risk 33% of your account per trade for maximum long-term growth, but would you actually do that? Of course not. Professional traders wouldn't either, because raw Kelly calculations aren't realistic for human traders and real market conditions. The psychological challenge with full Kelly is profound. Let's be brutally honest. Risking 33% of your account on a single trade sounds completely insane. Even if the mathematical calculations check out perfectly, your emotions will inevitably break you. Why? Because full Kelly assumes absolute certainty about your trading edge, that you'll execute flawlessly, markets will remain stable, and you won't hesitate when volatility strikes. In reality, that's pure fantasy. Even Ed Thorpe, one of the pioneering minds who first applied Kelly principles in blackjack and hedge funds, never used full Kelly. He understood that drawdowns could potentially exceed 50%, even with a proven edge. Most traders simply cannot survive such massive losses, neither financially nor emotionally. His solution was fractional Kelly, the approach favored by professionals. Most pros typically use between 10% to 25% of the Kelly number. So if Kelly suggests risking 33%, traders might actually risk 8% aggressively, 5% more balanced, 2.5% conservatively, and often the wisest choice is as low as 1% to 2% per trade. The reason is fundamental. Trading isn't about maximizing gains. It's about maximizing survival. Paul Tudor Jones captured this perfectly by stating that the most important rule of trading is to play great defense. The emphasis isn't on predicting well, but on defending your capital. Proper position sizing represents your first line of defense. There's an additional hidden risk that's particularly insidious. Kelly assumes you know your edge with absolute precision, but do you really? Was your backtest truly comprehensive or selectively cherry-picked? Were your trade fills idealized or reflective of real-world conditions? Have market dynamics fundamentally changed? If your actual edge is 30% weaker than your test suggests, and you size positions based on those optimistic calculations, you're dangerously overexposed. This is why professionals always incorporate a safety margin. If your system shows a 0.4 expected value, they'll conservatively assume the real-world edge might be only 0.25 and calculate Kelly from that more cautious baseline. It's not pessimism, it's insurance. In trading, survival belongs not to the bold, but to the prepared. Traders often shrink their positions when fear takes over, but professional traders approach sizing through mathematical precision, completely detached from emotional impulses. They don't ask themselves whether they feel good about a trade. Instead, they focus on critical questions. What is my strategic advantage? What position size provides protection and enables long-term compounding? This represents the power of probability thinking. It transforms position sizing from a subjective gut reaction into a scientific tool. It eliminates drama, removes guesswork, and neutralizes emotional tilt. Here's a practical framework you can implement immediately. If expected value remains unknown, risk 0.5% per trade. When expected value is confirmed through 100 plus trades, apply 25% Kelly sizing. During market drawdowns, reduce to 10% Kelly. If expected value turns negative, pause trading and conduct a comprehensive review. Want a straightforward formula? Position size percentage equals expected value multiplied by reward to risk at 0.25. Integrate this into your trading spreadsheet and make it a non-negotiable part of your checklist. Never again rely on random intuition. What happens when you size positions correctly? Drawdowns become manageable. Emotional turbulence subsides. Your perspective shifts from individual candles to entire trading campaigns. Your equity curve becomes smoother. You stop obsessing over single trade outcomes and start focusing on long-term strategic edge. Most critically, you become more resilient. In trading, survival is everything. Anyone can experience a lucky month, but surviving 1,000 trades requires discipline, mental fortitude, and mathematical rigor. Traders are often trapped in what I call the next trade obsession. They invest massive emotional energy in each subsequent click, believing it will somehow validate their skills, redeem past losses, or catapult their trading career. But the market operates on a completely different logic. It's not a Hollywood narrative waiting to unfold dramatically. The market is a cold mathematical system driven by probability distributions. These patterns only reveal themselves across large sample sizes. If your trading system boasts a 60% win rate, you must endure hundreds of trades before your statistical edge becomes apparent. During those hundreds of trades, you'll encounter losing streaks, false breakouts, seemingly random market noise, and trades that appear to make absolutely no sense. And this is entirely normal. Such experiences aren't signals that your system is fundamentally broken or mysterious market gods sending cryptic messages. This is pure mathematics in action. Think of it like a coin flip that can dramatically alter perceptions. Consider a simple experiment. Take a coin and flip it 10 times. You might see 7 heads and 3 tails, or perhaps 2 heads and 8 tails, or even 10 consecutive heads. Does this mean the coin is defective? Absolutely not. 10 flips represent an incredibly small sample where variations can dominate and mislead. Now imagine flipping that same coin 1,000 times. You'll likely see approximately 500 heads and 500 tails with minor statistical deviations. Why? Because as the sample size increases, randomness naturally balances out and underlying probability emerges. Trading follows an identical principle. Each trade resembles a coin flip with weighted odds. Some trades might offer 60-40 chances, others 55-45. But only across an extended period will your statistical edge become tangible. The real danger lies in traders' impatience. Most never progress beyond 50 trades. They abandon their strategy after experiencing 10 consecutive losses, enduring 3 flat months, or becoming emotionally devastated by a single trade that should have worked perfectly. They essentially abandon their edge before the probability distribution can even manifest, like declaring a coin rigged after observing merely 4 flips. The problem isn't the system, it's the trader's impatience, short-term attachment, and tendency to misinterpret normal variance as fundamental failure. This misunderstanding carries profound consequences. By prematurely abandoning a potentially robust strategy, traders sabotage their own long-term potential, mistaking temporary fluctuations for permanent inadequacy. Trading probabilities might seem daunting at first glance. Losing 5 consecutive trades happens with a 1.02% chance per 100 trades. 7 losses in a row occur once every 600 trades with a 0.16% probability. 10 consecutive losses, that's a mere 0.01% chance, appearing once in 9,765 trades. Sounds rare, right? Not exactly. If you're trading 20 times monthly, you'll encounter these streaks multiple times annually. Without understanding statistical distributions, each losing streak will feel catastrophic. The difference between amateur and professional traders lies in their mental approach. An amateur sees 6 consecutive losses and immediately assumes their system is broken, demanding immediate changes. A professional, however, maintains a calm, analytical perspective. Consider trade 47. With 26 wins so far, the trader calculates a 55.3% win rate, precisely within expected statistical parameters. No system adjustment needed. Where an amateur perceives chaos, a professional recognizes context. One reacts emotionally, the other responds strategically. This isn't just discipline, it's a fundamental identity. Building a distribution map becomes crucial. Create a spreadsheet tracking every 100 trades, divided into 10 segments. Color code win rates, expected value, and variance. Green represents normal range, yellow indicates extreme but possible outcomes, and red signals statistically improbable scenarios. Displaying this tracker near your trading screen provides immediate visual reassurance during challenging periods. When confronting 6 consecutive losses, you can quickly verify, I'm still within the yellow zone. This is survivable. My distribution remains intact. This visual reminder protects both your trading system and psychological resilience. Professional traders judge systems across entire series, not individual trades. They think like casinos, unconcerned with single-player wins or weekend losses. Casinos understand their edge emerges through millions of trials. Meanwhile, most traders panic after mere 3-trade losing streaks. The fundamental shift requires viewing trading through massive sample sizes rather than isolated incidents. Implement a daily routine. Log every trade comprehensively, tracking process quality. Monitor your 100-trade rolling average for expected value and win rate. Anticipate losing streaks as normal business operations. Evaluate systems only after 100 to 200 trades, never prematurely. Remind yourself daily, the next trade is irrelevant. The next 1,000 trades, that's what truly matters. When you shift your focus from outcome to process, to sequence, to system, you break free from the emotional roller coaster. 1 trade is just noise. 10 trades create chaos. 100 trades provide context. 1,000 trades, that's a legacy. Your mission isn't to win this single trade. Your job is to execute your edge, consistently, calmly, mathematically, and if you do, probability will handle the rest. The market doesn't reward luck. It rewards the consistent executor with a positive expectation. When you stop reacting to the trade right in front of you and start committing to the campaign ahead, you transform from a trader to a probability player. Now, let's confront something traders hate but must face: drawdowns. If you've traded long enough, you know that sinking feeling when your equity curve drops and doesn't immediately recover. The anxiety builds as one losing trade bleeds into the next. Self-doubt creeps in, whispering that maybe you're not cut out for this. Drawdowns are trading's crucible. They test not your strategy, but your very identity. Most traders don't fail because of their edge. They fail because they lack the mental framework to endure temporary decline. The question isn't whether you'll experience drawdowns. You will. The real challenge is, will you survive them? Let's examine the mathematical reality. Imagine you're running a system with a 60% win rate and a 1.5 to 1 reward to risk ratio, tested over 500 trades. It works, but here's the truth. You can still lose 6, 7, even 10 trades consecutively. Your equity curve might drop 20%, even 30%, and still remain within normal statistical range. Your system might appear broken when it's simply experiencing a cold distribution pocket. If you don't know your maximum expected drawdown, you're navigating blindly. You're emotionally reacting to something mathematically inevitable. Say your backtest reveals a maximum drawdown of 18%. Hitting 25% is rare but not catastrophic. Reaching 30% might warrant caution. At 40%, you might need to consider potential system failure. Yet most traders never define these critical boundaries. When traders experience pain, they process it emotionally rather than analytically, and this marks the beginning of a destructive spiral. The psychological descent follows a predictable path, and understanding this journey is crucial to interrupting its progression. In the first 2 days, denial sets in. Traders convince themselves this is merely normal market variance, and that things will soon turn around. By days 3 to 5, frustration takes hold. They question why this keeps happening, especially when they believe they followed all the established rules. As the second week approaches, panic emerges. Traders feel compelled to change something, often considering strategy switches. By week 3, desperation takes over. Their internal dialogue becomes a desperate bargain. If they can just recover their losses, they'll stop being so aggressive. Week 4 typically ends in burnout or a complete trading collapse. Traders conclude this isn't for them and want to quit. However, it's not the drawdown itself that ultimately defeats them, but their response to it. They start increasing trade sizes, deviating from rules, chasing losses, and abandoning logical thinking. Essentially, they transform from probability-focused traders to reckless gamblers. The critical distinction lies between a statistical drawdown and a genuine system failure. Not every drawdown signals a broken strategy. A normal statistical drawdown remains within historically calculated limits, maintains clean trade execution, occurs during stable market conditions, and keeps win rates within standard deviations. In such scenarios, traders continue executing trades, potentially reducing size and strictly adhering to their original plan. A true system failure involves more significant indicators, drawdowns exceeding back-tested maximums by over 50%, frequent rule violations, fundamental market regime changes, and statistically significant win rate degradation. Only then should a comprehensive system review be conducted. Most trading systems fail not because their edge disappears, but because traders abandon them prematurely. To protect both psychology and capital, a structured survival protocol becomes essential. At a 10% drawdown, continue trading normally while increasing journaling and tracking emotional states. At 15%, reduce position sizes by half and eliminate discretionary trades. A 20% drawdown requires trading at minimum size or switching to a demo account and initiating a full system review. At 25%, implement a complete trading halt, reset mental approach, and revalidate the system's edge, allowing no trades until absolute clarity is achieved. This approach serves as a critical fire drill, helping traders navigate challenging market conditions while maintaining psychological resilience and strategic discipline. Trading isn't about inventing solutions during chaos. It's about following a predetermined plan without negotiation because your survival depends on it. Pre-commitment is power. Drawdown planning isn't rooted in fear, but in strategic control. When you define your limits before the storm, you remain steady during turbulence. You avoid revenge trading, you prevent system switching, you protect your future self. Most critically, you stay in the game. Let me be absolutely clear. The primary reason most traders fail isn't a lack of skill. It's a lack of staying power. They never developed a process to survive their worst weeks, so they never reached their best ones. Look at the wisdom of survivors. Every legendary trader carries a brutal drawdown story. Ray Dalio lost everything and had to borrow $4,000 from his father. Stanley Druckenmiller suffered massive losses trying to time the 1987 market crash bottom. Paul Tudor Jones blew out 60% of his capital on a single cotton trade. What distinguishes these traders from average performers? Not an immunity to loss, but an extraordinary ability to learn, adapt, and rebuild. They established clear rules. They demonstrated remarkable resilience. They didn't just chase gains. They prioritized self-protection. Time for an identity check. Are you a survivor or a dreamer? Answer directly. What's your maximum acceptable drawdown? What's your specific plan if you reach that point? How will you respond to 10 consecutive losses? If you can't provide written, concrete answers, you're not trading, you're dreaming. And dreams don't survive markets. Systems survive, discipline survives, prepared minds survive. This is your opportunity to transform, from chasing highs to managing downside, from hoping to avoid drawdowns to expecting and outlasting them. Remember, every trader gets knocked down. The great ones rise not through willpower, but through systematic process. Drawdowns aren't avoidable, but your preparation is entirely within your control. Write your limits. Define your survival strategy. Respect market variance. When the inevitable storm arrives, you won't fight the sea, you'll navigate it. And when it passes, you'll remain standing, still trading, still compounding. That's the real victory. Most educators, mentors, and trading books keep a critical secret hidden. Your trading results are directly tied to your self-perception. The struggle isn't about lacking information, it's about operating from an incorrect self-image. The market does more than test your trading strategy. It tests your fundamental identity with every single trade. Until you transform your core belief from "I am a trader" to "I am a probability player," you'll continue repeating destructive patterns, regardless of your intelligence or skill level. This chapter represents a pivotal pivotal moment of transformation. We're moving beyond tactical discussions into a deeper realm of personal identity. Let's clearly illustrate the stark contrast between a trader and a probability player. A trader believes success means predicting market movements, feeling elated by wins and devastated by losses. They measure progress through outcomes, constantly asking, was I right? They react emotionally to market variance and obsessively tweak systems seeking perfection. In contrast, a probability player approaches trading fundamentally differently. Success means executing a proven edge consistently. They remain emotionally balanced whether a trade wins or loses, measuring progress through process and asking, did I follow my system? They accept variance as an inherent part of the game, improving through methodical journaling, backtesting, and analyzing large sample sizes. The difference is profound. One approach is emotionally reactive, the other is mentally resilient. One desperately needs to be right, the other prioritizes staying consistent. Ultimately, one path leads to burnout, while the other enables decades of steady compounding. This separation isn't about intelligence, it's about identity. Neuroscience research from MIT confirms that identity drives behavior more powerfully than willpower. When you think I'm a trader, your brain activates circuits focused on control, prediction, and performance validation. You feel immense pressure to win, take losses personally, and attempt to force success through constant adjustments. However, when you shift to thinking I am a probability player, your brain accesses an entirely different neural network. This network emphasizes acceptance of randomness, process execution, long-term thinking, and system-based attachment. It's not merely a philosophical belief, it's a genuine neurological transformation that gradually reshapes how you perceive risk, respond to winning and losing streaks, evaluate your performance, engage with the market, and ultimately determine your long-term compounding potential. Here's the rewritten text for the narrator. I discovered a powerful method to transform my trading mindset. It starts with language reprogramming. Every morning I speak a new internal dialogue. I am a probability player. I don't predict, I position. I don't chase wins, I execute edge. I don't need certainty, I operate with discipline. These aren't just words, they're identity anchors that gradually replace my old trading software with probabilistic thinking. When I lose a trade, I've learned to reframe my perspective. Instead of thinking I was wrong, I recognize this as part of my edge's probability. Losses aren't failures, they're mathematical expectations. My new mantra becomes clear. One trade doesn't define me. My execution across 1,000 trades tells my true story. I now score my process, not just my profits. My scorecard tracks critical elements: system adherence, entry validity, position sizing, stop loss discipline, and risk management. I rate each aspect from 1 to 10 and track weekly averages. The revelation is profound. My process score drives my profit curve. Improving my behavior, not chasing market predictions, will fix my equity. My environment becomes a critical transformation tool. I ruthlessly curate my information sources. No more prediction-based influencers or signal-chasing Telegram groups. No dopamine-triggering screenshots of random gains. Instead, I follow systematic traders and join communities built on process. I understand that the voices I hear daily shape my trading identity. Finally, I make my shift public. Declaring my commitment transforms internal change into external reality. I'm done chasing certainty, I announce. This isn't just a statement, it's a commitment to a new trading philosophy centered on probability, discipline, and systematic thinking. I'm fully committing to probability. I'm becoming a probability player. When I make this identity shift visible, my subconscious will take it seriously. I'll become accountable not just to others, but to myself. This isn't about seeking validation, it's about true alignment, because I'm no longer the same trader. I've upgraded, and my process now reflects that evolution. The final thought is clear: build a career, not a streak. Traders chase wins. Probability players build careers. Traders obsess over accuracy. Probability players obsess over execution. Traders get excited about one good week. Probability players plan 1,000 trades ahead. I need to ask myself, am I still trying to prove I'm right? Or am I building a system I can trust for life? When my identity shifts, my decisions shift, my emotional reactions shift, my performance stabilizes, my performance returns. Not because I've finally figured out how to predict markets, but because I've stopped trying to. I'm not a trader anymore. I'm a probability player, and I'll own it, live it, compound it. I've shifted my mindset. I've accepted this role. I no longer crave predictions. I execute process. Now comes the part most traders either overcomplicate or ignore: the system. Let me be absolutely clear. I can have the best mindset in the world, but without a defined, tested, and repeatable system, I'm still flying blind. The market doesn't reward effort. It rewards edge plus execution. This chapter is about taking everything I've learned so far, expected value, risk sizing, emotional discipline, statistical thinking, and embedding it into a system I can trust. Not one based on feelings, not one based on forecasts, but one built for mathematical logic and behavioral simplicity. Step 1 is understanding what a system is and isn't. A true trading system is a repeatable decision framework built to exploit a consistent market tendency. It is rule-based, not gut feel. It is quantifiable, can be back-tested, defined by probabilities, not certainties. It is process-oriented, executed the same way every time. It is not a one-time strategy from YouTube, something changed weekly based on a feeling or signal from someone else meant to win all the time. A genuine trading system provides clear guidance, when to enter, when to exit, risk management under specific market conditions, setup and validation points, and most crucially, a strategy you adhere to even during losses because it's mathematically designed for long-term success. Next, select your core market advantage. Every probability-based system revolves around one fundamental question. What repeatable market behavior or tendency am I exploiting? Consider potential edges. Momentum continuation where strong price movement tends to persist. Mean reversion where overextended prices often return to average levels. Breakouts from compressed trading ranges where low volatility typically precedes high volatility. Liquidity traps where price manipulates key levels before reversing. Or time of day volatility patterns with more predictable movement during certain hours. Select a single core edge to begin. Focused specialization trumps complexity. Avoid chasing every potential pattern. Choose a specific niche and master it comprehensively. The goal is one edge, one setup, one outcome executed with precision. Define your setup with absolute clarity. Suppose your chosen edge is trend pullback continuation. Your setup might include specific entry criteria, price positioned above 200 period exponential moving average, confirming long-term trend direction, pullback to 21 EMA, presence of bullish candlestick patterns, RSI between 40-60 indicating controlled momentum, stop loss positioned below pullback structural low, profit target set at 2 times risk or utilizing a trailing stop under subsequent higher lows. Implement disciplined position sizing, allocate 1% of capital per trade, maintain fixed risk parameters, and consider Kelly-based scaling only after accumulating 200 trade samples. Apply time filters, restricting trades to London and New York market overlap, avoiding entries within 15 minutes of major economic announcements. The setup must be so precisely defined that another trader could execute it identically. This level of specificity distinguishes a professional approach from amateur speculation. Most traders crumble under pressure because their trading approach lacks critical safeguards. The key is establishing clear protective rules. Set a maximum daily loss limit. If 2 risk units or 3 consecutive trades result in losses, stop trading for the day. Implement a weekly reset mechanism. When experiencing a 7 risk unit drawdown in a week, pause, conduct a thorough review, and regroup. Create no trade zones. Specifically, avoid trading Friday afternoons. Prevent revenge trading by implementing a 15-minute cooling off period after a stop out. Never trade after a losing streak without first logging and analyzing the performance. These rules effectively remove personal emotions from decision making. They aren't restrictive constraints but essential life support for your trading strategy. The next critical step involves comprehensive journaling. Document not just outcomes, but the entire process. Serious probability traders track far more than simple win-loss ratios. Record every detail. Did you execute the setup precisely? Was your position sizing appropriate? Did you hesitate or prematurely enter? Analyze your emotional state before, during, and after each trade. Over time, this meticulous tracking will reveal behavioral patterns and hidden performance leaks. Your true competitive advantage emerges not from complex indicators, but from consistently refining your approach. Treat your trading system like a franchise operation. Consider McDonald's. Their performance remains consistent regardless of individual employee mood or location. Your trading should mirror this systematic approach. Trade as a disciplined operator, not an artist or gambler. The market doesn't reward heroics or creativity. It rewards scalable, consistent execution. Your trading system functions as a personal mirror, reflecting your discipline, patience, long-term thinking, and ability to relinquish control. Simplification breeds trust. Trust enables execution. Execution allows mathematical probabilities to work in your favor. This methodology transforms unpredictable markets into predictable results, not through forecasting or chasing, but through a probability-based system operating with machine-like precision. You now possess the mindset, risk framework, emotional foundation, and systematic approach. The tools are in your hands. The ultimate choice remains. Will you methodically run the system or surrender to emotional impulses? Only one path leads to a sustainable trading career. You've reached more than the end of a presentation. You've arrived at the threshold of a transformed professional identity, one that no longer seeks absolute certainty. You feared losses like failure. You looked at the market and asked what will happen next. But now you have seen the other side. You have stepped into the world of probability, of systems, of process, of long-term thinking, of trading like a casino, not a customer. And in doing that, you have done something most never do. You have stopped trying to control the market and started controlling yourself. That is the shift that changes everything. The ocean does not apologize. The market is like the ocean. It does not explain itself. It does not reward your feelings. It does not care how badly you need a win, but it does reward those who respect its nature, who build boats that can weather the storm, who do not try to predict the next wave, but navigate the tide, who do not panic when tossed around, because they trust their vessel. Your system is that vessel. Your mindset is the sail. Your risk management is the anchor, and your edge, that is your map. When all four align, you do not fear the water. You move through it with intention and the right tools. Let me recap what you have built. You understand that prediction is the enemy of consistency. You think in expected value, not win rate. You size positions like a professional, not a hopeful amateur. You judge performance over hundreds of trades, not just one. You survive drawdowns with discipline, not desperation. You have upgraded your identity from emotional trader to probability player. And you have built a system you can trust, one that does not require perfection, just repetition. This is no longer about catching one big trade. This is about building a trading life, rooted in logic, clarity, and freedom. And now a new door opens. Let me ask you a final question. What would your trading look like if you let go of needing to be right forever? No more over trading. No more tweaking after every loss. No more emotional highs and lows. No more second guessing your worth with every candle. Just clear, calm execution of a process that works because it is built to work over time. That is not just trading. That is freedom, the probability player's creed. Let this be your silent guide from here forward. I do not predict the market. I respond to probabilities. I do not judge myself by the outcome of one trade. I judge myself by the consistency of my process. I do not need certainty to succeed. I just need edge, risk control, and discipline. I do not chase trades. I execute my system. I do not fear drawdowns. I manage them. I do not try to control the market. I control myself. I am not here to win today. I am here to compound forever. I am a probability player. You have done more than watch a video. You have started a transformation. And if you keep showing up this way, one trade at a time, one decision at a time, you will become the kind of trader who does not just survive the market. You will become the kind of trader who outlasts it. Don't forget to like, subscribe, and tell us in the comments how you're learning to care for yourself. Your words might inspire others.